stocks remain heavy after European gas flows from Russia get shut off. EU energy ministers hold an emergency meeting this week as markets start to price out some of the downside risks as support packages in the billions get announced. All eyes are on the ECB this week, who are expected to hike 75 bips as inflation data looks rampant. Volatility markets likely stay firm ahead of CPI and FOMC later this month. All this and more in this week's Macro Insight. Okay, welcome back to Macro Insight, everyone. Today is the 6th of September, and let's take a look at these markets. So if I share my new sort of volatility dashboard summary page, this is what we're kind of focusing everything on now going forward. So if we bring this up, what do we see? Now, this is from sort of close of business yesterday, so we've had a little bit of a pop in market since then. But basically, stocks kind of traded pretty heavy into month end, as September is seasonally quite bad for markets. And then we had a little pop briefly on NFP on Friday, and that got faded pretty fast as the Nordsteam news came out that they wouldn't restart gas flows to Europe, and then European stocks got hit quickly, about 3%. Rates markets showed some re-steepening last week as the front end traded quite range bound, but longer end yields continued to go higher. As inflation data in Europe stays firm, and people are now starting to wonder if the acceleration of QT and the extra supply of bonds hitting the market is going to take longer dated yields higher now, right? They have been kind of pinned down by growth concerns lately, but as macro data has actually not been as bad as expected recently, we're starting to see some of that unwind and some of that extreme kind of flattening that was happening with inverted yield curves going to like -50 in the 2s 10s. They're starting to get unwound, and we're now seeing -20 in the 2s 10s, which are levels that we saw back in July. The dollar continued to inch higher. So DXY briefly at 110, above 110. Worst hit currency of the week, as you can see, on a vol adjusted basis. We had the pound getting hit, obviously a bit of uncertainty in the UK around who was going to be the prime minister. That's now been resolved. But pound really testing that 115 level, which was a major level if you look back on a longer term chart, and had that really broken in style. Who knows how much downside that opened up, right? So market's pretty fearful in sterling on that test of 115. Euro, on the other hand, was kind of hanging around that parity level. It was holding on quite well till the Nordstream news, and then it kind of accelerated down a bit. But it's still kind of hanging in there, to be honest. There's a potential for a 75 bip hike coming out of the ECB this week, and that's probably keeping a bit of a floor under the euro right now. How long that persists, who knows? But that's kind of where we are. Commodities also softer on the week as dollar strength and more China lockdowns keep a lid on things there. Credit continues to look weak. High yield, not far from the HYG ETF, not far from the June lows, as QT is set to accelerate in September. And we think credit markets will probably be impacted from that. And then lastly, crypto staying heavy, in line with risk assets. ETH trading in line last week, started to outperform a little bit over the last few days as these sort of mid-September catalysts approach. Obviously, we've got CPI next week, we've got FOMC, and then we've got the merge thrown in the middle on like the 15th, 16th there. So that's next week. So a lot of potential action coming up over the next couple of weeks. In terms of this week, obviously, we've got Bank of Canada decision expected to hike 75 bips. ECB, like I said, pricing in about 80% probability, I think, of 75 bips as well on Thursday. ISM services, I don't know, is that out yet, or it's imminently coming out later today in the US. And then we've got some China inflation data, and we've got some Fed speakers dotted around the week. I think Powell speaking on Thursday. So that's kind of the highlights, really. But really, all eyes on the ECB. If we then look at kind of rates markets and what they've been doing, so this chart here from Bank of America shows that we had this kind of, hope of a Fed pivot come in sort of at the end of July, and that was helping fuel the rally in stocks, and that's pretty much been completely priced back out, right? So the rates market has kind of pushed Fed funds pricing back to where it was on the 14th of June, which was basically the lows in the S&P down at 3650. So rates market's kind of taking it all back. Equities is yet to. Let's see if it does over sort of the coming month or two. In terms of the probabilities for the September FOMC meeting, they've stayed pretty stable over the last month, right? So you can see kind of the 75 bip hike is kind of these bars here on the right, and the probability's kind of been hanging around between 60 and 70% for the whole month. So that's kind of how the market's looking at it. Obviously, CPI next week could move the dial on that, but hard to really make a call on that, right? Obviously, we had a big pullback in CPI or an undershoot last time round. Markets now thinking we have peaked. Energy prices are kind of behaving themselves. Gasoline prices have rolled over. So we may well get another low print here where the market might then price that more towards 50-50 going into the number. So that's something to watch out for. And that's definitely something that could fuel a bit of squeeze risk in stocks if the number comes out lower than expected again. Yeah. Big picture, we tagged that 200-day, we sold off. Big level was 3,900, and it seems to have held for now. Okay. Zooming in on the shorter term stuff, we obviously saw that little pop, NFP pop there, very brief, got smacked back down pretty sharpish, but that was pretty much after we found out that Nordsteam wasn't coming back online and everyone got spooked, right? But for now, the 3,900 level seems to be a reasonably strong support. It held a couple of times last week. In terms of the upside, we know there's a big strike at 4,005. It's this big JP Morgan collar strike that's the call that they've sold, and that expires at the end of September. So that's going to provide the street with some vol. The closer we get to expiry, that's going to turn into a shit ton of gamma, right? If we're still around that 4,000 strike. So you may find post FOMC, if we're in the vicinity of 4,000, we're going to struggle to move materially away from that until after the end of September, right? If, however, we move away because of the macro data spooking the market and we go lower, we start to head towards 3,600, then that's a totally different kettle of fish because the street's actually short that strike in the same size, approximately $20 billion notional. So things could get quite hairy down there, I believe. Okay. Relatively light calendar this week, like I said, in the US. So we may get a sideways to kind of drifty market to the upside. I do think implied vols will hold up, though, in anticipation of the CPI and the FOMC. So don't expect VIX to really crater. Stocks do look a little bit oversold in the short term. So like I say, I think if the CTAs are done selling, and there was a lot of noise around the CTAs turned sellers last couple of weeks as markets broke down. If the CTAs are kind of done selling and they're a bit more balanced here, then that might mean the market can kind of grind its way up a little bit, right? But medium-term picture still does look more bearish, I would say, than bullish, just given the tighter for longer message from the Fed. And like we said, net liquidity rolling over in Q4 is probably going to keep a lid on markets. Yeah. So, China, so if we look at the carry side of things, so the realized vol, China continues to realize pretty well. You see that there's a negative, that's the only one with a negative. So it's saying realizes above implied. Okay. Whereas the S&P and Eurostox, they're still marginally positive, right? So Europe's moves last week did take away what looked like quite attractive carry last week. So we were saying that Europe was where the juice was. It wasn't realizing implieds were high. Implied seemed like they were high for a reason, and we got some movement to justify that. So you haven't quite gone negative, but the amount of juice that you have in selling gamma in Europe is reduced dramatically as that implied volatility is popped, right? Another way we can see that is here. We zoom in on these bars. You can see the realized vol was hanging in at around 16 and it's popped to above 20 now, basically, right? And so we were at max earn territory. The carry indicator is now only showing the 63rd percentile, and with around 3 vol points of carry, it's not looking quite as attractive. Okay. And this is why I was wary to just go and sell a load of puts like the strategy compass here was telling to sell puts, because you can see if we move over to the spot chart, we're down at the lower Bollinger Band, so stocks look oversold. Vol looks a little bit inflated. So the mean reversion trade is to sell puts. But the problem with the mean reversion trade is when it goes wrong, it can go very wrong. And when you've got a fundamental driver like what's going on in the European energy crisis, you want to be careful about selling that tail, basically, right? So I would say that's why I said I wouldn't sell the puts as a way to earn carry. I would rather do it on the upside. And if you did do that trade, then you've basically moved away from that short gamma on the upside. So it's kept you alive, basically, right? You haven't got too damaged there. Yeah. Now, what's interesting to me is the SKEW in Europe, right? So you had Nordsteam shut down, but if you look at the SKEW, and this is the 25 delta SKEW in Europe, it was kind of at the top of the range, little mini range that it's been in. It got whacked, right, yesterday. So after the weekend and after the Nordstream news, you've got European energy ministers calling an emergency meeting and SKEW getting smoked in European stocks, basically, right? So clearly the market kind of feeling like we may be towards the end of the bearish news flow here, and these guys are going to do something about it now, basically, right? So prices can keep squeezing to the moon. Russia's turned off the taps, but now they're going to do something to help people out, right? So, Germany announced a 65 billion package of support. And that's kind of why the market is now sort of taking out some of that left tail in Europe. Okay. Now, in terms of, what that's going to do for inflation, that's a good question, right? I mean, if they're going to subsidize and they're going to bail people out, then that's not really going to help bring inflation back down. There will obviously be energy rationing and things like that. And that probably will help reduce demand and stuff. But it's just, it's not clear that longer term is a good strategy to bring inflation down, right? When they're just doing subsidies and bailing people out and printing more money, basically, right? They're trying to raise rates on the one hand to get inflation in check, and then on the other hand, they're stimulating and throwing billions to support people because of the energy crisis. So they're a little bit stuck, if you ask me, right? They don't really know what to do. But anyway, SKEW is back to sort of more median levels in Europe, and SKEW in general in equities is kind of on the low end of things still, as it hasn't really performed that well, right? As we've seen, as we talked about last week, as stocks sell off, the VIX popped a bit, but it's not really anywhere near where you would have expected it to be, given what's been going on, right? Okay, and then finally, sort of looking at term structures here, you can see you've got S&P in a contango. As short-dated vols do find sellers on S&P fairly regularly. It's a fair amount of systematic flows there still. Europe, obviously, slightly inverted because people are just a bit wary of selling short-term European risk, given the headline risk. And then you've got China, where you've actually got a bit of a hump in the curve, where the front end's coming down, but this middle sort of 2-month area is where the peak is in the volatility, and that's because they've got their National Congress coming up on the 16th of October, right? So that's kind of keeping some event risk in China around that date, and so it's not surprising to see the curve kind of bending a bit around that date, right? It's kind of how it tends to work when we have known events on the horizon. Yeah. Okay, so that's what I'm seeing in equity, vol, and SKEW. And then just one last thing on that point about SKEW kind of coming down. This is like the price of European gas and German power futures. Okay, and just kind of, you can see, whilst they are obviously, they did pop on that news, they are well off their highs, right? So those markets that are the epicenter of the stress are not at their highs despite the current news flow. So that to some extent is telling, and may well be also why, the vol markets are pricing out some of that tail on the downside, basically. Yeah. On that note, I mean, FX still does have a bit of SKEW being priced to the downside on euro and things like that, but certainly equities kind of started to price it out. Yeah. We're also cutting in energy. Energy under pressure, obviously, as gasoline prices have come down on weaker demand, but diesel remains strong. So demand for diesel is still strong because that's used more by industry. Gasoline's more used by consumers. So those guys are like, okay, we won't drive as much, fine, but industry needs to do what it needs to do. And obviously, China lockdowns are still weighing on sentiment. The news flow in commodities has been interesting in that we did get an OPEC cut yesterday. So this wasn't expected, right? It wasn't a massive cut. It's like 100K barrels. But basically, it was more of a signaling than anything else. So they basically signaled that, they want to support prices. So much to Biden's dismay, I'm sure, as his SPR reserve releases are going to come to a close. But basically, the truth is it's not much of a cut, right? So if you look here, the OPEC production, what they've managed to be producing versus what their quotas were, they've had a shortfall of, about 1 million barrels, right, for ages, right, since kind of Jan 21, Feb 21, right? So a year and a half. So by cutting their quota by 100K barrels, it doesn't make any difference, right? So the supply and demand story isn't really changing because they weren't making their quotas anyway, right? There was a shortfall anyway, so they weren't able to produce as much as they're allowed to. But like I say, it's just signaling from the Saudis that, yeah, we're not going to let prices roll over, whatever you want, Biden, basically, right? On that note, I dipped my toes into a call spread last week on USO as the market did have that dramatic down 5% day. So I managed to get into some trades that were on my radar, which was the USO November 82.95 call spread, paid $2.50 for that. It gives me roughly a 4-to-1 risk reward to November if we get a decent rally in oil. Obviously, we do need to rally quite a bit, 20% plus for me to max out on that thing. So it may not get to the top strike, but for me, it's a nice way to carry a long position in oil. The reason I chose the call spread is obviously because vols are pretty elevated. So if you look at the dashboard in oil, you can see, we've got sell put screening as the trade here. That's too dangerous for me, right? I don't want to sell puts on oil. If it breaks these key long-term uptrend levels, God knows where the downside is, right? So I don't want to play with fire. And I know that oil vol, whilst it might look inflated from a percentile rank, it can go to 80 plus, right? And right now it's only at 50. So I'm not going to get too brave and sell puts on oil right now. So I'd rather own call spreads as my bullish expression. And I've done it in the medium part of the curve in November. So you can see that, even if vol does retrace a bit from the recent spike that it's had, the front end can come down from 52 to, 42, even like 10 vols. But that November part of the curve, look where it was a month ago. It was still at around 47. And right now it's around 49.50. So it doesn't have quite as much downside as the front end does. So I feel more comfortable owning what little Vega I do own in the call spread. I'd rather own it in the 3-month bucket than the 1-month bucket, which is more susceptible to getting crushed at some point. Okay. So that's the logic there behind the call spread trade. And like I say, in general, look, the positive carry is telling you that options are not a good outright own. The expensive level of implied is telling you that it's not a good outright own. So everything's pointing in the direction that if you want to use options to express your directional view, make sure you do a spread and keep your Vega risk to a minimum, basically, right? That's the idea. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.